Welcome back to another edition of China Update, your source for in-depth political, economic, and geostrategic coverage of the world's second-largest economy. I'm Tony. Normally, weekends are our time off, but today's developments are too important to wait until Monday. There are some major, and frankly worrying, stories to break down before the new week begins. Let's dive straight in. Chinese economy. Sacrificing profitability to preserve social stability. Earlier this week, Bloomberg released a comprehensive feature titled, China Forced to Keep Unprofitable Firms Alive to Save Jobs and Avoid Unrest. The report highlights that China is currently grappling with its largest number of loss-making industrial enterprises since 2001. President Xi Jinping is walking a tightrope, attempting to restructure the economy while preventing mass layoffs that could spark social instability. The piece paints a vivid picture of the situation. One example is the Jini Qinyang Chongshang Brewing Company, a decades-old distillery in northwestern China. Despite running at a loss since 2020, the plant continues operating, mainly due to concerns about the social consequences of closure. If we shut down, our workers will lose their income and pensions, explains Megan Xiao, who helps run the company. The facility employs around 300 workers, some of whom are part of a government poverty alleviation program. Stories like this are becoming increasingly common. According to official statistics, the proportion of loss-making industrial firms has reached its highest point in over 2 decades. A combination of factors is at play: weak domestic demand, deflation, shaken consumer confidence following the property sector collapse, and growing international backlash against China's industrial overproduction. This puts the Communist Party in a bind: reduce excess capacity and risk a wave of unemployment, or keep inefficient companies afloat and further burden local finances. Xi's administration appears determined to avoid any repeat of the widespread protests that ended the zero-COVID policy in 2022. Freedom House data shows protest activity rose by 41% year-on-year in late 2024, underlining the political sensitivity of employment issues. The labor market situation has become so delicate that some of China's most prominent job platforms have stopped publishing wage data. Meanwhile, Xi's uncompromising stance against U.S. tariffs, initially imposed during Donald Trump's presidency, has fueled nationalist pride at home but worsened the export climate for Chinese manufacturers, many now facing tariffs of up to 30% on goods bound for the U.S. overcapacity in sectors like steel, chemicals, and automobiles has triggered a wave of anti-dumping investigations from the U.S., EU, and other major partners. The Bloomberg report draws a contrast with the 1990s, when Premier Zhu Rongji's tough reforms closed thousands of inefficient state-owned firms, paving the way for China's manufacturing boom. Today, much of the overcapacity exists within privately owned companies, over which local governments have less control. Political priorities like national security and technological independence have made Beijing increasingly intolerant of economic volatility. To tackle inefficiency, Beijing has tried to restrict local subsidies and preferential tax breaks. In 2023, the State Council even banned unauthorized local government financial support. Regulators also urged banks to cut off credit to zombie companies that survive solely on subsidies and loans. But enforcement remains weak. Local officials, judged on GDP growth, employment, and social stability, are reluctant to close factories. In provinces like Shaanxi, once a coal hub now rebranding as a clean energy base, the consequences are stark. Nearly 40% of industrial firms recorded losses in 2024, almost double the national average. One case is Dawn Automobile, a local electric vehicle maker once hailed for job creation. After failing to pivot successfully into the premium EV market, the company entered court-ordered restructuring in 2024. Yet, despite cutting half its staff, production continues, a sign of local resistance to market-driven exits. China's bankruptcy process, while improved, is still cumbersome. Judges are wary of approving closures due to personal accountability for potential unrest. In some cases, courts must preemptively visit protesters and resolve grievances before allowing bankruptcy filings, showing the system prioritizes social order over economic logic. This pattern repeats thousands of times across the country, resulting in remarkably low default rates. Economists warn this has broader consequences. The lack of market discipline for weak firms hurts stronger companies, said S&P Global Ratings chief Asia-Pacific economist. Some reformists, like renowned economist David Lee Dao-Kuei, have suggested a quota system allowing companies that shut down to sell production rights to others, creating a market incentive to reduce capacity. But Beijing seems unwilling to adopt such measures. Ultimately, the government's reluctance to allow layoffs may preserve social stability in the short term, but it risks deepening structural economic problems. With the economy slowing and protests, including labor unrest, on the rise, China's options are narrowing. Peking University finance professor Michael Pettis points out that such policies also act as de facto trade policies, boosting production faster than consumption and pushing more goods into foreign markets, adding to global trade imbalances. Europe-China, trade relations under strain. Shifting to Europe, the EU is stepping up scrutiny of its economic ties with Beijing. A surge in Chinese exports, industrial unrest, and geopolitical tensions are testing what was once a stable, mutually beneficial trading relationship. Chinese customs data from May shows a sharp divergence. Exports to the U.S. fell 34.5% year-on-year due to rising tariffs, while shipments to France and Germany jumped 24.1% and 21.5%, respectively. This has raised suspicions in Brussels that Chinese companies shut out of the U.S. market are redirecting surplus goods to Europe, often at discounted prices. The European Commission has warned against rushing to conclusions, but it has rolled out a new customs surveillance system designed to detect such trade shifts. Still, action is already being taken. The EU recently imposed provisional anti-dumping duties of up to 62.4% on Chinese hardwood plywood, citing a 3-year import surge that undercut European producers. This follows Beijing's recent attempts to ease tensions, illustrating the complexity of EU-China relations. In a significant shift, Germany's influential Mechanical Engineering Industry Association, VDMA, once a strong advocate for engagement with China, has now called for a far tougher EU stance. German manufacturers say they're being undercut by Chinese competitors benefiting from heavy state subsidies under industrial policies like Made in China 2025. The VDMA warns Europe risks becoming a dumping ground unless countervailing duties are enforced. Data supports these concerns. EU exports to China fell 7.3% in the first 5 months of 2025, while German machinery exports dropped 12.2% in Q1. In contrast, Chinese exports to Europe are surging, particularly to Germany and France, raising fears of lopsided trade dependence. European Central Bank President Christine Lagarde, speaking in Beijing this week, warned that without more balanced trade, the world could face a new depression. She urged both surplus and deficit nations to adjust policies, pointing to rising industrial subsidies and skewed demand patterns. Further complicating matters are allegations of Chinese banks aiding Russian sanctions evasion and Beijing's push to secure EU certification for its domestically built C-919 passenger jet, a likely bargaining chip at the upcoming July EU-China summit. Some speculate that an Airbus deal could become part of the negotiations. However, despite ongoing dialogue, EU diplomats doubt quick resolutions are likely. Even a potential compromise on electric vehicle tariffs, replacing duties with a minimum import price, seems out of reach for now. The EU's relationship with China is shifting into uncharted territory, touching not just trade but the broader future of the global economic order. That wraps up today's China Update. Thanks for watching.